Stackers and apes ignore the rigged charts for a second. Forget RSI. The moving averages, those painted lines meant to blind you while the real signal flashes unseen. Today, the true indicator isn't technical. It is the clock. It is Tuesday, December 30th, 2025. Burn this date into your mind because markets recall these shifts long after the mainstream headlines fade away completely. We are exactly 48 hours out from a total structural fracture in the global silver game. Not a dip, not volatility, a fracture. When the calendar hits January 1st, the rules shift. The ball is about to drop not in Times Square but in Beijing. Chinese export ban is the hard deadline, and the markets never, ever wait for deadlines. They move ahead of them quietly, decisively, where the average sheeple are not looking now. If you think panic starts with an official press release, you don't know how this rig is played. Panic starts in silence. It starts in overnight funding markets, in dark vault corridors, in decisions made before dawn by banks that cannot afford to hesitate. And this morning, in less than an hour, we saw stark proof that something fundamental has cracked. What happened was not mere noise. It wasn't random volatility. It was a full systemic seizure, the kind that only appears when fiat leverage collides with reality. Two tectonic plates are grinding against each other in real time. The Western Ponzi is fighting with liquidity, with digits, with emergency patches designed to buy time. The Eastern system is fighting with gravity, with physical metal, with assets that cannot be printed or promised into existence. These two worlds cannot stay aligned for long. One side always gives way. At precisely 8:15 a.m. Eastern Time, the first fracture became visible. The sound you hear in the spot price is not fear. It is stress. It is a system straining under weight it can no longer carry. December 30th, 2025 may be remembered as the day the fiat illusion started to fail in plain sight. If you are ready to understand why this matters now, type A1 to continue or 2 to stop. And before we go further, subscribe to the channel and comment one so I know you are watching this big moment with clarity, not emotion. Now let's talk about what actually happened beneath the surface this morning, because this is where most investors lose the plot. While headlines were quiet and screens looked almost normal, the rigged financial system flinched. At exactly 8:15 a.m. Eastern Time, before the cash market even opened, the Federal Reserve executed an emergency liquidity injection. No press conference, no warning, no scheduled operation, just a valve opened and billions pushed right into the system. This matters because central banks do not improvise when conditions are healthy. In a stable market, liquidity operations are planned, announced, and boring. What we saw today was none of those things. It was off-cycle, unscheduled, and urgent. That tells us something broke in the plumbing. Somewhere in the system, a major institution woke up short of fiat cash at the worst possible moment. Think of it like this. Banks lend to each other overnight based on trust. They exchange cash for collateral, confident they'll get it back in the morning. When that trust evaporates, the entire system locks up. And when it locks up, the only place left to run is the central bank. That is exactly what happened today. Someone went to the window and said, "I need billions right now, or I simply cannot open for business." This wasn't stimulus. This wasn't support for the economy. This was emergency triage. The financial equivalent of a defibrillator slammed onto a patient who was supposed to be stable. And when you see that kind of response before the opening bell, you really have to ask why. Institutions don't panic without reason. They panic when leverage turns against them and time runs out. What makes this moment so important is timing. This liquidity stress didn't appear in a vacuum. It appeared as silver volatility surged and physical supply tightened. These things are connected. The paper system depends on calm, predictable pricing. When volatility spikes, margin requirements rise, and suddenly paper promises need real cash behind them. That is when weak hands get fully exposed. This morning was not about price discovery. It was about survival. And the fact that survival required emergency intervention tells you everything you need to know about how fragile the paper side of this market has truly become. While the West was scrambling for liquidity, something very different was happening half a world away, and this is where the story stops being abstract and becomes physical. At nearly the exact same moment, the Federal Reserve opened the emergency valve in New York. The Shanghai Gold Exchange witnessed one of the largest physical silver withdrawal events in its history. This was clearly not coincidence. This was pure choreography. 41 tons of silver were removed from the exchange in a single morning. Not traded, not shuffled between accounts. Removed, loaded out, driven away fast. That distinction matters more than any price print on your screen. Trading volume is noise. Physical withdrawal is intent. When metal leaves an exchange, it is no longer part of the game. It cannot be rehypothecated. It cannot be promised to 10 different counterparties. It is fully gone. To understand the significance, you need to feel the scale. 41 tons is not a hedge. It is not inventory management. It is a total evacuation. You do not move that amount of metal unless you believe it will not be available later at any price you are willing to pay. This is what panic looks like when it wears a suit and answers to a long-term industrial strategy. And look at the timing. December 30th, 2 days before China's export ban takes effect. The buyers weren't guessing. They were counting hours. They saw the calendar, saw the coming restrictions, and decided not to negotiate with uncertainty. They swept the floor. No crumbs left behind at all. This was a statement: possession matters more than price. Here is the key insight most people miss. The West responded to stress by creating fiat money. The East responded to stress by acquiring metal. One side printed digits to stabilize confidence. The other side took atoms to secure reality. That is not just a market difference. It is a philosophical divide, and history is very clear about which side survives moments like this. This withdrawal tells you the physical market has stopped trusting the paper market. When trust disappears, price becomes irrelevant. Availability becomes everything. And this morning, availability vanished completely. Now, we need to connect these two events because viewed separately, they look unusual. Viewed together, they form a single signal. The Federal Reserve injecting emergency liquidity and China draining physical silver at the same time is not random. It is action and reaction. It is massive leverage breaking on one side and preparation accelerating on the other. In financial markets, there are no coincidences. There is only stress traveling through the system until it finds the weakest point. This morning, stress showed up as a sudden need for cash in New York and an urgent need for real metal in Shanghai. Both sides were responding to the same problem from opposite directions. When a major institution is short silver through derivatives, volatility is truly lethal. As prices swing, margin requirements rise. Cash must be posted immediately. If the cash isn't there, positions are liquidated, defaults cascade, and the illusion collapses. That is why liquidity was injected, not to support markets, but to prevent a chain reaction. At the same time, Chinese industrial buyers and strategic holders were looking at that same volatility and reaching the opposite conclusion. They weren't worried about margin. They were worried about access. They understood that once the export ban takes effect, the flow of metal changes permanently. So while the West fought to keep the paper game alive, the East acted to secure real supply. This is what a squeeze actually looks like. Not a line going up on a chart, but a collision between paper claims and physical limits. It begins when those holding paper realize there may not be enough metal, and those holding metal realize they don't need to sell. That stark realization spread this morning. This is also why price suppression at this stage is not a sign of strength. It is a sign of fear. You smash price when you are cornered, not when you are confident. You manipulate when you are losing control, not when you have it. The violence in today's price action is the sound of a system buying a little more time. Time, however, is exactly what this system no longer has left. To understand how fragile this situation has become, we need to look at the structure of the paper market itself, because this is where the illusion is maintained. In New York, silver is not traded as metal. It is traded as contracts, promises layered on top of promises, moving at the speed of algorithms. The system only works as long as very few people ever ask for delivery of the metal. On this particular day, the numbers crossed into absurd territory. In a single session, hundreds of thousands of silver contracts changed hands. On paper, that represents more silver than the world produces in an entire year. In reality, almost none of it existed. This was not supply. It was synthetic volume recycled claims traded back and forth to create the appearance of vast abundance. Here is the critical point. Out of that ocean of paper, only a microscopic fraction ever stood for delivery. The ratio between paper claims and physical movement has ballooned to levels that cannot survive stress. Thousands of paper ounces now exist for every single ounce of real metal that actually changes hands. That is not price discovery. That is plain dilution. Here is exactly why that spot price on your screen feels totally detached from reality. Flooding the market with paper supply crushes the true signal. Yet that suppression demands constant energy leverage, blind faith, and flowing credit. The second, just one of those factors fades, this whole rigged charade starts to wobble. This morning's chaos exposed that heavy wobble. The paper Ponzi needed emergency aid to float, while the physical side voted no confidence and walked. This gap cannot hold. Markets can survive high leverage, but they surely cannot survive widespread disbelief. When physical stackers see paper prices as noise, they quit the game. They pay premiums, they stack deep, they take delivery. Once that starts, the paper market is left pricing a ghost asset that it absolutely no longer commands. This is the stage where cracks stop being theory and start becoming plainly visible. The rig can still run, but only under heavy strain, and strained Ponzi schemes do not fail gracefully. This split is now visible in the one place that truly matters: cost. Not the fake spot price on a screen, but the real price paid to secure the metal. As stock tightens, premiums jump. When premiums blow past normal ranges, they are flashing distinct warnings, not opportunities. In Shanghai, silver has started trading at a juicy premium to New York. In a healthy integrated market, that gap would shut instantly via arbitrage. Traders would buy cheap, sell high, and move metal until prices fix. That mechanism is the glue that holds global pricing together. But that glue has finally failed. Metal is not moving west to east. It flows in one direction only, and once it moves, it is gone. Export blocks, logistical drag, and strategic stacking have broken the arbitrage loop. What you are seeing is not mispricing, it is total bifurcation. This is the moment when two prices emerge. One price for paper promises another for possession. The paper rate reflects what leveraged shorts can defend for one more day. The physical price shows what real stackers are willing to pay to eliminate counterparty risk entirely. That huge difference tells you where power has shifted. When buyers accept higher prices without hesitation, it means their priority is not return. It is certainty. They aren't speculating, they are securing. And markets driven by security behave very differently from markets driven by profit. Once this dynamic takes hold, it accelerates fast. Rising premiums show scarcity. Scarcity invites stacking. Stacking drains supply. Removing supply raises premiums further. This feedback loop is what breaks markets, not headlines. The paper scam can argue with charts. It cannot argue with empty vaults, and right now the empty vaults are doing the talking. At this stage, the most dangerous mistake a stacker can make is to focus on spot instead of structure. Price is the last thing to move. Structure moves first quietly, invisibly, until it hits a point where price is forced to catch up in a violent, jagged way. That is precisely where we are now. The paper silver scam only functions because participants believe they can exit when they choose. Liquidity is assumed, not guaranteed. But this morning showed us what happens when that assumption weakens. When one bullion bank struggles to meet margin, the chain tightens. Credit becomes selective. Trust evaporates. And suddenly, every leveraged position becomes a massive liability. This is why volatility is exploding. It is not random. It is the mathematical response of a leveraged system hitting its limits. When leverage is high, small moves require massive tamping. When tamping becomes constant, confidence erodes. And when confidence erodes, the exit door becomes extremely crowded. Meanwhile, physical stackers are behaving rationally. They are not reacting to intraday candles. They are reacting to policy, supply chains, and strategic necessity. They understand that silver is not just metal, it is an input. It is energy, conductivity, infrastructure. You cannot replace it with liquidity. This is where long-term thinking separates from short-term noise. The whales draining vaults are not trading this week's volatility. They are planning for years where access matters more than price discovery. They are willing to absorb short-term premium pain to eliminate the long-term existential risk. When markets shift from speculative behavior to defensive behavior, the rules change. Sellers vanish, buyers become insensitive to price, and paper schemes designed for fluid trading begin to fail under the crushing weight of physical reality. That transition is already well underway. The only question now is timing, not direction. Now let's talk about timing, because timing is the accelerant. Structural imbalances can exist for years, but they only become explosive when a deadline approaches. January 1st is that hard deadline. It is the moment when uncertainty turns into certainty and optionality disappears. Markets hate uncertainty, but they fear certainty even more when the outcome is restrictive. Over the past few days, every major player has been forced to make a decision, not tomorrow, not next quarter, now. Do you trust paper exposure through a system showing visible stress, or do you convert that exposure into something real before the window closes? This is why activity has become compressed, aggressive, and quite unforgiving. As the calendar tightens, behavior changes. Risk managers stop debating probabilities and start preparing for consequences. Traders stop optimizing and start protecting. And when protection becomes the priority, liquidity dries up. No one wants to be the last seller. No one wants to be holding a bag when delivery becomes truly impossible. This is also why last-minute price smashes are so dangerous to misinterpret. They are not signals of weakness. They are signals of desperation. When price is pushed lower into a known supply vacuum, it is an attempt to shake loose metal from strong hands that understand exactly what is happening. It is a transfer mechanism, not a reflection of value. History shows this pattern repeatedly. The most violent price suppression often occurs right before a market breaks free. Not because fundamentals weaken, but because control is slipping. The closer the deadline, the more force is applied, and the more unstable the rigged system becomes. As we move closer to January 1st, the margin for error shrinks. Every hour matters, every decision compounds, and once the clock runs out, there is no rewind, no renegotiation, no liquidity injection that can restore a broken supply chain now. This is the phase where preparation replaces prediction. The outcome is already forming. The market is simply catching up to the truth. By now, the pattern should be unmistakable. This is no longer just a story about silver. Silver is simply the pressure point where a much larger system is revealing its weakness. What we are witnessing is the erosion of trust in intermediaries, in promises, in layers of abstraction that only function when confidence is unlimited and time is abundant. Right now, neither one exists. When markets fracture like this, the greatest danger is assuming normal outcomes. People expect resolution to look familiar. A dip gets bought, a spread closes, stability returns. But systemic breaks do not resolve smoothly. They resolve unevenly. One side adjusts violently while the other quietly exits the rigged game. The paper market is built for liquidity, not scarcity. It works beautifully when supply feels endless and confidence is high. Scarcity reverses everything. Contracts turn into liabilities. Exposure becomes risk. And the difference between holding an asset and merely referencing it becomes painfully clear. This is why the messaging feels contradictory. Calm narratives coexist with emergency actions. Reassurances are paired with stress signals. That disconnect is the space between what must be said to maintain order and what is actually happening deep underneath. For stackers, this is not an intellectual test. It is a psychological one. Can you ignore spot price while structure is breaking? Can you stay disciplined while volatility tries to force emotion? Most cannot. That is why wealth transfers happen during moments like this. The institutions removing metal understand this. They are not chasing returns. They are eliminating failure risk. They are stepping outside the system instead of betting on its durability. And when that behavior spreads far enough, the adjustment becomes inevitable. We are much closer to that point than most people realize. This brings us to the final and most important question. What do you do when you realize a system is changing in real time? Not a theory, not a prediction, a transition. The answer is not panic and it is not guessing. tops or bottoms, it is pure positioning. Every major financial shift follows the same pattern. Structure breaks first quietly. Volatility rises as control weakens. Then price adjusts suddenly to match reality. Most people only react at the final stage when risk is highest. The disciplined stackers act earlier when the pressure is psychological, not financial. The lesson is uncomfortable but clear. Paper fails when trust fails. Leverage fails when liquidity tightens. And markets fail when physical limits are reached. These failures do not announce themselves. They reveal themselves through emergency actions and behavior that no longer matches the narrative being told. Silver is the signal. It is exposing the limits of promises in a world that now prioritizes possession. This does not mean smooth price action. It means continued volatility until the rigged structure resolves. The real key is clarity. Always hold physical metal. Avoid paper promises and counterparty risks. Know the gap between paper exposure and holding